Hello everybody, welcome to this week's edition of Northwest Quadrant Wealth Management e-News. We sit here today on tax day, April 15th. Hopefully everybody got their taxes in. And now we're in the middle of a little bit of a sell-off here. If you hadn't noticed, it hasn't been that big of a sell-off, but it's the first one we've had in a while. And so I think markets are finally coming to the realization that interest rates probably aren't going to be cut very much, if at all, this year by the Federal Reserve. When you look at the data coming out of the U.S. economy this morning, we got retail sales that were way better than expected. So the consumer is still spending. In the last jobs report, unemployment actually went down. We're now at 3.8% unemployment, which is more than full employment. And we also got some inflation data last week that still show inflation hotter than the Federal Reserve would certainly like it. Almost twice as high as where they want the target inflation rate is. So all of that points to why would the Federal Reserve cut interest rates? Because the U.S. economy, when you look at the activity at the consumer level, it doesn't feel like interest rates are restrictive at all. In fact, when you look at the behavior of the U.S. consumer, you would almost consider the interest rate complex currently as a little bit stimulative. So, and markets, I think, now are finally coming to the realization that maybe interest rates aren't going down anytime soon, and this higher for longer narrative is probably more likely than getting 3 or 4 rate cuts, which is what market participants wanted. And so we're seeing the riskiest of the risk assets sell off, as you know, those are the assets that do well in a low interest rate environment, and we don't think we're going to get that. So Josh can talk sort of about the current volatility in the equity markets.
Remember back in early October, the last time we were here on the 10-year yield, which now is just over 4.6%, give or take, depending on what minute you're looking. There's been a lot of volatility there, but stocks were actually 30% lower the last time yields were this high. And so it's more about volatility in yields. That's what markets want. They don't want uncertainty with respect to interest rates. So the Fed's obviously not going to raise. So again, stocks, we have a rather contrarian take here, which is that ultimately this is all good news for markets. Here we are, earnings season just kicked off on Friday. Earnings are coming in significantly better than expectations, which really shouldn't be a surprise. Again, the economy is very obviously strong. There's certainly people in different income cohorts that are suffering as a result of this protracted battle with inflation. But again, the economy is strong. Earnings are good. You should expect slightly higher yields than we've seen, just baked in off this expectation of cuts. But again, yield cuts or interest rate cuts will come. They're probably just not coming until 2025 at this point.
Yeah, so remember, this volatility we're seeing in the stock market is sort of to be expected. I mean, we haven't had any in a while, and so it's this push and pull between what rates are going to do and the expectations of market participants. And so remember, investing is not a binary decision. It's time in the market rather than trying to time the market. We had lots of volatility last year in 2023, yet the stock market had a really good year. So we don't see any reason for it to be that much different this year. So stay invested. As always, if you have questions about your situation, your account, give us a call at the office, 800-743-0988, or you can email either one of us, Josh or Tyler, at northwestquadrantwealth.com. We'll see you back here in 2 weeks.